The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, 401k Loan and Distribution Basics with Melissa Cawood and Stephanie Reed. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions you may have for Melissa and Stephanie, and they will answer as many questions as time permits. Please be sure to make your questions as descriptive as possible. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com, and we'll be sure to get those to Melissa and Stephanie. Right below questions, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who meet the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce to you from Nova's distribution and loan team, Melissa Cawood, head reviewer and trainer, and Stephanie Reed, distribution team leader.
Hey, good afternoon, everyone. Welcome to our webinar on 401k loan and distribution basics. Just a general disclaimer, a couple of housekeeping items here. The information in this presentation is intended to be general in nature. It's not intended to be tax or legal advice. And we do encourage you to consult a qualified professional, such as an attorney or an accountant, if you do need legal or tax advice. And then as Yvette mentioned, this is eligible for continuing education. If you need CPA credit, our provider number is listed here on the screen. You'll need to make sure you're registered individually and then just keep an eye out for that link for the evaluation form. And then we'll get that over to you within a week of the webinar being concluded. Today's agenda is going to go over first distribution basics. We'll talk about the different types of distributions and some tax issues surrounding distributions. After that, I will turn this over to Melissa, and she's going to discuss loans with you, and she'll go over some vesting information. Also, she'll go over some of the common problems that we run into in processing distributions, and we'll also discuss some cybersecurity issues. And then, of course, at the end, we'll take any questions that you guys have as long as we have time. So when you complete the webinar, we want you to take away an understanding of mandatory and optional distribution options that we can have from 401k plans. We also want you to be able to identify and understand loan provisions and requirements, and also understand how vesting applies to loans and distributions. To begin with, we're going to go into our distribution basics. So once 401k money does go into a plan, it has to meet certain criteria before it can be withdrawn. And this is because 401k plans come with a lot of tax advantages. And so as a result, they also come with a lot of IRS rules. And one of those rules is about when money can actually be withdrawn from plans. So we listed below here some of the more common reasons that participants are able to take funds out of plans. The most common being, of course, termination of employment or retirement. Another common one is this in service for employees that are currently working who are age 59 and a half. Hardships are another common one we see. Then unfortunately, participants occasionally do become disabled, or they may pass away and their beneficiaries are able to withdraw funds. And then another common one we see is rollover distribution. So if you roll money into your current employer's plan from a prior plan, it's really common for your current employer's plan to allow you to take those rollover funds at any time. Our first item here is the termination of employment or retirement condition, and this is typically it's going to be a voluntary distribution that's initiated by the terminated participant. a participant will terminate or retire, and they'll typically reach out to the employer, or they may reach out to NOVA and request a distribution. Typically, when we get these, if we get them right after employment, we will hold them until we get the final payroll contribution. And that's because if we don't do that, you may have these trailing contributions in the plan. They're often small amounts, and sometimes they don't get distributed because participants usually have to request a second distribution, and they may not do that for a small amount, or they may not realize that they can do it. And sometimes when they do request it, the checks are small and they may not feel motivated to cash them. So these small trailing contributions do create some issues for the plan, which is why we typically hold a distribution for that final payroll contribution. Usually for most participants, it's just a week or two. A lot of the requests we get are past this time frame and we don't have to hold them at all, but this does come up now and then. Along with the termination distributions is this concept of an involuntary force out distribution. You may also have seen it referred to as a cash out distribution, and this is designed for small accounts. So plans have this option they can add to their plan, and most plans administered by NOVA do have this provision. And for terminated participants with small accounts, typically $5,000 is the threshold, although occasionally it's $1,000. If they don't elect to take a distribution from the plan, they can actually be forced out. And when we do these force outs, and we do them for most of our clients, these distributions are rolled over into an IRA in the participant's name. And if you have a force out provision under 1,000, you do have a couple of options here. Again, this is an employer-initiated transaction if the participant doesn't make an election. And it's for vested balances under 1,000. And you can also, when you're doing these, you can include rollover accounts or not, depending on how the plan is written. But for under 1,000, they can be mailed a check. So the participant would get a check, and then we would deduct the 20% tax withholding. Typically, we discourage this because oftentimes these checks don't get cashed. So that's why we encourage plans that have these provisions just to apply a rollover to all amounts under 5,000 and not to try to pay these under 1,000 amounts out as cash distributions. But again, for any of these, you can always contact our distributions team if you have questions about it, and our distributions team email is there at the bottom of this slide. And then another thing just to keep in mind is that most of our plans are updated with force out provisions. And again, you can always contact your account manager if you have questions about it. And again, you can reach out to our distributions team and we can help you with that too. Now for involuntary force outs, when the amounts are over 1,000 and under 5, the force out does have to be a rollover. And again, you know, as with the under 1,000, this is an employer initiated transaction. And you can exclude rollovers when you're calculating the account value for these. Plan document must have this provision, and again, most of our plans do. And these, again, are all rolled into IRAs in the participant's name. So the participants still have access to the funds, you know, further on down the road. And again, you can reach out to us if you have any questions on the force outs. We do a big force out project for our clients every year. So we're happy to answer any questions or help out with that in any way. The next distribution provision we have here is the age 59 and a half, and this is an in-service provision. It's super common in 401k plans to see this provision, but it is optional, it's not required, but I would say most plans probably do have this age 59 and a half. And this is a provision that allows employees to take distributions while still employed. It can be restricted to different types of contributions. You know, typically it will apply to 401k contributions. The employer can decide whether or not they want it to apply to employer contributions as well. There is no early withdrawal penalty, and that's part of why it's an age 59 and a half distribution. So 59 and a half is the magic age when you can avoid that 10% early withdrawal penalty. And then the other thing too about the 59.5 is that's the age at which the IRS will allow participants to take their 401k contributions while still employed. So that's why that's set at 59.5. But something to keep in mind is if you do take a 59.5 distribution and you don't roll it over, it will be subject to income taxes. So that's something for participants to keep in mind if they do want to take an in-service at 59.5. Another really common distribution is a hardship, and this is another in-service distribution, but it's a little more specialized than the age 59.5 distribution. Again, it's optional, but it's fairly common in 401k plans, and this gives participants access to their 401k accounts if they have an emergency. Since most participants are going to be under 59.5, it will probably be subject to the early withdrawal penalty. And of course, this is a taxable distribution, so participants will want to keep that in mind if they need to take the distribution. But again, sometimes participants have a special need and they must take funds out of their plan. Hardships do require some extensive documentation to make sure that it's a qualified hardship. So that's another thing to keep in mind when you're administering hardship distributions. So most plans are written with what we call a safe harbor hardship provision. And this kind of helps limit some of the administrative burden of hardship distributions. The safe harbor hardships, and these are IRS safe harbors, limit these hardship distributions to a few different criteria that the IRS has decided is counts as an extreme hardship. We've listed them here. The first one is the purchase of a primary residence or the prevention of foreclosure or eviction from the primary residence. The next couple for unreimbursed medical expenses and educational expenses are available for both the participant and their spouse and dependents. There's also an option of a casualty loss hardship, and this is typically for repairs to your home that are the result of an extreme event, such as a fire or a flood, a tornado, that type of thing. Occasionally we'll get requests from people who want funds to repair their home, especially in the summer. We'll get a few for people who are looking to replace their air conditioning systems for obvious reasons, but those don't count as casualty losses. It's not for repairs, it's for these more extreme events. Another one that we do see frequently is for burial expenses for the participant, not the participant, but for their spouse and their dependents. There's also a possibility of hardships if you live in a federally declared disaster area. So if you have a hurricane and you have damage because of the hurricane and you're in a federally declared disaster area, you may be eligible for a hardship for that. There were some changes a few years ago to hardship distributions, and these changes are a few years old now, but we still wanted to include them because a lot of people don't realize that these changes did go into effect. So this is just a reminder that, before these 2019 changes, participants had to take plan loans before they took hardships, but that's no longer a requirement. Participants don't need to take a loan. The other change that was really important and has been really great on an administrative side is that participants now can take investment earnings. So before 2019, they could only take their contributions. They couldn't have earnings on the contributions, but now we don't have to track that anymore. They can have the entire amount. The other thing too that went away is that participants do not have to stop making 401k contributions. You can take your hardship this week and next week, excuse me, you can continue making your 401k contributions. These provisions have been included in our plan documents for a few years now, so it's nothing new, but it is a good reminder. And then, excuse me, you can always reach out to your account manager if you have questions on the hardship provisions. A couple of other items for hardships is that employer contributions can be available Most plans that have hardships allow the 401k contributions, and fewer of them allow employer contributions, but it's becoming a little more common. And then the other thing is that you can now also include safe harbor contributions, which is not something that you were able to do prior to 2019. And again, with hardships, we have to have substantiation, so invoices, receipts, and so on. Anytime someone requests a hardship, we're able to give them a list of examples of documentation that would meet the substantiation requirement. And there's also a hardship withdrawal certification participants have to sign that essentially says that they are experiencing a hardship and they don't have any other funds to pay for the hardship situation. Another common type of distribution is this rollover distribution. So sometimes participants will roll funds over from a prior plan, and these are kept in a separate source in the plan. And a lot of plans that allow rollovers also allow participants to take those rollover contributions at any time. And one of the big reasons for that is it encourages participants to roll funds into the plan. So if you know that you can take these funds out if you need them, then you're much more likely to roll them over into the plan to begin with. Another common distribution provision is the death distribution. Unfortunate, but people do pass away, and when that happens, their beneficiaries may have access to the funds, and it's really important. The key takeaway here is it's just really important to make sure that you have beneficiary information on file if at all possible. So the plan sponsor should be maintaining this information. Sometimes a record keeper where the assets are invested will maintain the beneficiary information. But the important thing is that you need to have it on file. And if you're married, your spouse is going to be your default beneficiary and has to consent if you want to designate a different beneficiary. And if a participant doesn't have a beneficiary on file, the plan document does have a stated order of distribution. So it would, of course, first go to a spouse. If there's no spouse, it would go to children, then the participant's parents, and then finally their siblings. And then the other thing for distributions for death is that death certificate is generally required to accompany a distribution form when you're submitting one for a death claim. Another common distribution that we process are required minimum distributions. And these are distributions that typically happen at age 72. It used to be age 70 and a half, but they changed it a few years ago. So now that it's age 72. And this is a requirement that participants that are age 72 or older must annually take a distribution from the plan. And this is just to make sure that participants are taking income from their plans and they're not deferring their taxation on their accounts indefinitely. A couple of things to keep in mind here is that if an age 72 participant wants to do a full rollover from their account, we do require that they take the RMD first because RMDs are not eligible to be rolled over. And again, this applies to participants that are age 72 and are terminated from employment, and then also for active employees that are 5% owners, if they're age 72, they also have to take their RMDs. Participants that are not owner employees, if they're still working for the employer, then they can actually delay their RMD until they terminate employment. And this is a project that NOVA does for their clients every year. And I know our slide here says that we initiate this in October of every year, but this year we're actually initiating it earlier, and we are getting ready to initiate it in August. So our clients will start seeing notices about RMDs here in the next few weeks. Another distribution that we do process frequently is a qualified domestic relations order. And this usually comes up as a result of a divorce. Occasionally, you'll also see it for child support. but it's essentially the participant will divorce their spouse and their spouse will be awarded a portion of the account balance. Yeah, the rules are really complicated. They involve divorce decrees and court decrees. Usually takes us a few days to process them. So if you have a participant that is in this situation, they're getting divorced, just know that it's not an immediate process, but we're willing to do what we can to help them through it. We can help them review their paperwork to make sure that it's going to satisfy the quadro requirements before the court finalizes it, so we can be a resource there. And if you do have a participant in that situation, please just have them reach out to our distributions team and we can help them with their quadro process. Spousal consent is something we get asked about now and then. For 401k plans, spousal consent usually is not required. Other types of retirement plans, like pension plans, will require spousal consent, but 401k plans rarely have that as a requirement. And we generally discourage it because it really just slows down, the whole process of trying to take a withdrawal from your plan. But generally, if spousal consent is required from a plan, it usually only applies to distributions that are more than $5,000. Not typically smaller accounts, it wouldn't apply, even if the plan does have a spousal consent provision. But plans that you most likely will see spousal consent, again, defined benefit plans, pension plans, and then there's a type of defined contribution plan called a money purchase plan. That you don't really see those plans anymore, but some older 401k plans will have old money purchase money, and that will be subject to spousal consent. So when participants make a distribution request, they do have to take into account tax considerations. And so as part of that, they're required to be provided a special tax notice that explains some of the tax consequences of the distribution. It also tells them how they can defer distributions by rolling their plan over. It's a notice that the IRS prepares. They have a model notice, and it's just something that should be given to each participant when they make a distribution request from a retirement plan. As far as taxation issues surrounding retirement plans, it's something to keep in mind is that most distributions are subject to a 20% federal tax withholding if they're not rolled over. And they are also subject to 10% early withdrawal penalty for most participants that are under age 59 and a half. There are a couple of exceptions to that, but generally speaking, there will be a 10% early withdrawal penalty. And if it's a cash distribution, the entire distribution is going to be taxable income. For rollover distributions, they do not typically have to pay any tax withholding. They can continue to defer their taxation. This can be rolled over to an IRA or a new employer's plan. Rollovers are not available for hardship distributions or RMDs, so those will be taxable income. And if you do a rollover from a pre-tax to a Roth, you won't pay taxes when you do the rollover, but the participants still will be subject to taxation when they file their tax return. We do see some of those conversions, so it's one of the things participants should keep in mind if they're looking to convert their pre-tax dollars to Roth dollars. And now I am going to turn this over to Melissa, and she is going to jump in here with participant loan basics.
All right, thank you, Stephanie. So I'm Melissa Cawood. I am a trainer for the distributions team, and I'm going to start us out with some loan information. So loans is an optional plan provision. You do not have to have this in your plan, but it does allow employees access to their 401k plan funds while they're still working, and that can encourage participation. One of the reasons people don't participate is because, I don't know if I can afford to not have that money. Well, here's an option that they can still have access to it while still trying to grow these retirement accounts. As a plan sponsor, you might not want the administrative burden that comes with loans, but there are ways to make them more restrictive so that it's not a free-for-all and loans are not taken as frequently. You can make loans only for hardship reasons. You can put in there that you only want participants to take their deferrals. You can make it as strict as saying they can only take 50% of their deferrals. So there are ways to make it to where loans aren't taken as frequently and making it easier to administer. Loans are not taxable distributions, which is one of the reasons why people love them so much. You can have access to your money, but have the option to put it back into the account. It still will hurt a little bit towards their overall retirement income, but not as severely as a distribution would. Loans should be paid via payroll deductions. We shouldn't be relying on a participant to send in a paycheck or a payment once a month. That doesn't work very well. So the payroll deductions would be set up. And if a plan does not currently allow loans, we would have to have an amendment in order to get them added. So let's click to the next slide here. So first thing, loans are allowed. The participant's going to want to know what their maximum loan amounts will be. So generally speaking, a participant can borrow 50% of their vested account balance up to $50,000. That $50,000 is also going to be reduced by their highest outstanding balance in the last 12 months. So that is something, we have an example we'll get into that explains that a little bit further, but that's something that a lot of people don't know. This is also one of those things where, as a plan sponsor, writing that loan policy, you could make it more restrictive, like I said. You could make it 50% of the employee sources only, so that they're not even touching the employer sources. But without those restrictions, this is the maximum, 50% of the vested account balance up to $50,000. A loan policy will dictate the number of loans that can be outstanding. It will dictate the minimum loan amount. And so NOVA has some recommendations that we like to put out there when we're creating a loan policy. No more than one loan, because just administratively, if you've got a participant that has 4 loans outstanding, it can get really confusing in making sure that all those payments are being made correctly and on time for the right amounts, and that they're stopping on at the right times. We recommend a minimum loan amount of $1,000. The lower that loan amount is, the more loans that are going to be taken, the more burden it's going to be. We recommend that you require repayments through payroll deduction. Like I said, a lot of record keepers will not accept personal checks from participants. So participants would have to pay the plan sponsor, who would then have to turn around and submit the payment electronically to the record keeper. Life happens and people forget to make those payments. So doing it through payroll deduction just makes life a lot easier for everybody involved. And then we don't generally require or recommend requiring spousal consent. It's generally just not needed. It is something that you could put into your loan policy if you wanted to, though. So there are some requirements. If we're going to have a loan policy, we have to stay within these parameters. A loan has to have a reasonable rate of interest. So if I was going to go to a bank and get a loan, I would expect to have a similar loan interest rate from one of these loans out of a 401k plan. The loan policy will set the rate. We typically see something like prime rate plus 2%. You can get a little creative with it, but the more creative you get, then the more we have to really look at it. Are we hitting that reasonable definition, which gets a little complicated. So NOVA documents typically have that prime plus 2%, although I have seen some different ones, like prime plus 1, things like that. Generally, a loan cannot go more than 5 years. There is only one exception, and that is for a situation when a participant is purchasing their primary residence. That time frame could be longer. The loan policy can limit what that will be. Typically, you see 20 years in those loan policies. But any other situation at all, regardless of what it is, 5 years is the maximum. Again, we would want the loans to be paid through payroll deduction. But in parentheses there's a note that a lot of people do not realize. When it is coming out of your paycheck, that loan repayment, it is coming out of your paycheck on a post-tax basis. If the loan was taken out of a deferral account, that's a pre-tax source. Well, that loan repayment is done on post-tax, is going to go back into a pre-tax source. So it is a little bit of a tax issue there that a participant might not realize when they're taking that. Something that they should consider, fully consider the full cost of taking a loan before they go and request one. And then something everybody needs to know is that loans generally become due when the participant terminates their employment. If we do not follow the loan requirements, we don't have a reasonable rate of interest, or we don't pay the loan back, anything like that, then the plan is going to be left with a prohibited transaction. So that loan will be deemed a distribution. It will be taxable. And the amount of that outstanding loan balance is going to be subject to taxes. The participant is under the age 59 and a half. That also means that early withdrawal penalty, that's a 10% penalty tax. So it's definitely something we want to avoid. We want to make sure that no loans are ever deemed as distributions, that we follow our loan policies to a T, and then we get those loans paid back correctly and on time to avoid any taxes. There are fees with taking loans. NOVA does charge a loan initiation fee. It will be in the client's engagement agreement. The record keepers also often charge an initiation fee. It's going to vary by record keeper. A lot of them will charge also an annual or monthly, sometimes quarterly maintenance fee for that loan. That is not something that NOVA charges at all. We just have the initiation fee. Sometimes the record keepers, if they don't have an initiation fee, they're going to have a larger maintenance fee. And sometimes if they don't have a maintenance fee at all, they're going to have a larger initiation fee. Generally speaking, from what I've seen, the record keepers, it all evens out to be about the same though. But it is something that participants need to know. Again, they need to understand the full cost of taking a loan before they request it. And the participants need to know that they bear that cost. It's an optional thing. They do not have to take a loan. So the participants would be responsible for the fees of requesting and maintaining those loans. So now that they know, kind of they want to take a loan, they want the maximum loan, they want to know how fast they can get the money. So how do we make it to where they get it as fast as possible? First piece of advice is to understand the process for your record keeper. Taking a loan from, a John Hancock plan is going to be a little bit different than taking it from a Voya plan, as an example. So if it's possible, we want our participants to apply online for a loan. The online record keeper participant websites are very sophisticated. All of them have the ability for participants to model different loan scenarios, look at their maximum loan. If they take a loan for 1 year versus 5 years, that's going to drastically change their repayment amount. So all of that they can kind of play around with online before applying. And then of course, that application, it immediately gets logged into our system so that we can get started on that request right away for them. If possible, we want them to request an ACH payment instead of having a paper check mailed. The mail was already kind of slow, and then COVID hit, and now it's even slower. So definitely ACH is always recommended. But this is a situation where understanding your specific record keeper is super important. A lot of record keepers require that they have the ACH information on hand ahead of the request coming in. And that's for fraud prevention procedures, just to make sure that there's no funny things happening, that the participant is the one, they've got that ACH information on file, it's been verified, then the loan request comes in. If the record keeper doesn't have that, Voya is a good example of this. They will not send ACH, they will only do a paper check just to protect the participant's assets in case there was something funny going on there. So participants do need to allow sufficient time to receive the funds. If we do have to have a paper check, the mail can take 7 to 10 days. An ACH can take 2 to 3 days. We have to have time for the bank to route the funds to their accounts as well. So it's not just the time for requesting the loan, it getting reviewed and approved, actually processed by the record keeper, but then the bank has to do it as well. So different banks can take different amounts of time. You just need to know it's not an ATM. They're not going to be able to get those funds same day, but we will get it processed as fast as possible for them. So I do have a few examples here. This first one's very simple. Participant's account balance is $2,000 and they want a loan for $1,000. Well, if this plan document allows for one loan with a minimum $1,000 withdrawal, we would be able to process this because 50% of their account balance is $1,000, which is the minimum. I would caution participants though, this happens a lot where the second they're able to take a loan, they request it. If the markets drop in between them requesting that loan and it actually getting processed at the record keeper, it's going to be canceled. So with the markets being as volatile as they can be, it's just something to keep in mind. People might want to think about giving themselves a little bit of a cushion and waiting until it's a little bit above that minimum amount before they make that request, or just be understanding that if the markets do drop and their account drops below 2,000, they're going to have to put that on hold and wait until the account goes back up. In the second example, we have a situation where a participant already has an outstanding loan balance. So they've got a total vested account balance of $2,000 that includes their outstanding loan. And they're requesting a new loan of $1,000. The plan document here in this situation does allow 2 loans to be outstanding at a time, but it also has a minimum $1,000 loan requirement. In this situation, we would not be able to approve because while 50% of the participant's vested benefit is $1,000, they already have a loan outstanding. So we would have to subtract that out. We have to make sure we take that into account when we're looking at maximum loan amounts. So this particular participant wouldn't be able to take a loan of more than $600. And since that is less than the minimum loan amount in the plan document of $1,000, we would have to deny this request. This example is the one that is the most interesting in my opinion. So we've got a participant here that has a very large account balance. They're sitting pretty at $100,000. So in February, they borrowed $30,000 and then they fully paid it back right away, just 2 months later in April. And now they want a second loan. So we have to factor in the highest loan balance in the last 12 months when we're doing these calculations. That is an IRS requirement. It will be written into all of the plan document or loan policies in the plan documents as well. So 50% of their vested account balance is $50,000. But because of that highest balance being $30,000 in the last 12 months, the maximum loan amount this person can get is $20,000. This is something we really want participants to look at what their new maximum will be after they pay that loan back before they pay it back. If somebody, thought, oh, well, I'm going to pay this $30,000 back really fast and then I'm going to turn around and take a $50,000 because I should have taken the $50,000 loan in the beginning, that is not going to work. So definitely, these can get a little complicated. We understand that. Feel free to reach out to our team and we can calculate the highest loan amount that somebody can take, in a hypothetical situation. If they pay that loan back, what would their hypothetical new loan be able to be? We can look at all of that for you before somebody actually goes and pays $30,000 and then can't do what they want. We don't want a participant to be in that situation. Okay, so we have some recommendations on how to avoid loan defaults. A loan default is basically a loan did not get paid off. Maybe the participant terminated employment or whatever situation is, and the loan repayments never continued being made. Maybe something happened in payroll and we stopped the loan repayments. We've got a default situation. Well, first of all, we want to make sure that loans are only taken, loan repayments are only done through payroll deductions. Don't rely on participants to send in funds every month because it doesn't work. People forget, life happens, and having it come directly out of their paycheck without the participant having to think about it prevents those issues. Definitely, when you have a new loan, you want to get those loan repayments set up immediately in your payroll system. Make sure you have the correct start date and enter a total goal amount into your payroll system, which is going to be the number of payments times the payment amount. So that once that goal amount is hit, the loan repayments are stopped out of the paycheck. If somebody goes on a leave of absence, let us know, let the record keeper know. We can freeze a loan if a participant is on an approved leave of absence for up to a year. So, somebody, I don't know, has a baby and they're going to be not working for a while. Well, obviously, if they're not getting paychecks, we can't make those loan repayments. That is not a problem. We can freeze the loan, put it on hold, and then when they come back to work, we can get you a new amortization schedule so that the repayments can continue. There's other leaves of absences, military leave, for example, things like that. If you switch payroll providers, that's often a situation where the loan repayments get messed up. But, we got to set up a new goal amount, and sometimes that gets messed up. So definitely look at all of that very closely to avoid as many loan defaults as you can. Loans that are not paid back are subject to taxes, and that can be very costly for the participant. The higher the loan balance, the larger the amount that they're going to owe in taxes. So anything we can do to help prevent that for participants is a good thing. If you do have a situation where you've got missed loan repayments, there are options to avoid that default. The first option is to make a balloon payment, to where we can have the participant come up with the funds, we make one payment to get us back on track, and then we continue following the amortization schedule. Or oftentimes that doesn't work because the participant doesn't have extra funds laying around. So we can re-amortize that loan for you whenever needed. If you realize you're behind 5 payments and we get you a new schedule, each payment going forward will be a little bit bigger, but we will get it all factored in so that the loan is still paid off in time before the maturity date so that we don't have a default. Also, there's a grace period built in. It will be in your loan policy, but it is built in so that we have time to get these issues fixed when they come up. Because, we're all humans. Things do happen. Sometimes payroll systems do get messed up. There are leaves of absences. It's okay. We just need to make sure we get them fixed as fast as possible. So a grace period is kind of wordy on how it works, but I'll explain it. You have until the last day of the calendar quarter following the calendar quarter that the first payment was missed. So if a payment was missed on a loan in April, you're going to have until the end of September to get that fixed. You're going to have a minimum of 3 months, and depending on when in the calendar quarter the first payment was missed, you could have closer to 6 months to get it fixed. So there's plenty of time. Whenever these issues come up, if we try to watch for these, the record keepers try to watch for these. If you happen to know that there's going to be an issue like a leave of absence, reach out, let us know, and we'll get it taken care of so that we do not run into a default issue where the participant is taxed. Okay, moving on, we're going to talk about vesting for just a minute. So vesting is just an employee's ownership right to the benefits in the plan, and they accrue over time based on a schedule that is going to be defined in the legal plan documents. So it's kind of a wordy way to say, but basically a participant would have to earn their employer money, the money that they contribute to the plan, whether it's through rollover contributions or deferrals that are submitted from their paychecks. They don't have to earn that money. That is 100% always theirs. But the employer funds are generally going to be subject to this vesting, where they have to earn it over time. Certain funds are always 100% vested. Those are Safe Harbor, QNEC, QMAC, rollover contributions, and employee contributions. But things like employer match and profit sharing are the ones that are going to have a vesting schedule attached. There's 2 different ways to calculate vesting. This particular slide talks about the hours method. It's the more common method. Most of our plan documents have this. But a year of service under this method is going to be calculated on a plan year basis. Most plan years follow the calendar year, but not always, so we do have to look at that. But basically, you would get 1 year of vesting service credited for each plan year that the employee works 1,000 hours. Now, in your plan document, you could limit this to 750 hours if you wanted, but I believe all NOVA documents are on 1,000 hours, and that's definitely the most common. It takes the average full-time person about 6 months to work 1,000 hours, so even a part-time person can hit this within 12 months. Obviously, if you work overtime, things like that, you're going to earn it faster. Vesting is going to be calculated from the original date of hire, not from the date that they became eligible for the plan, and not from the date that they actually start contributing to the plan. So if somebody doesn't want to contribute to the plan for years and years and they change their mind, we have to calculate the vesting from when they were first hired. So those people could, in a lot of cases, already be vested. There is an option for calculating hours when we don't track hours. So if you've got a salaried individual and you have no reason to keep track of the number of actual hours they work, we can use what's called the equivalency method. The plan document would define exactly which equivalency method we're using. Typically, though, we see it's 190 hours that are going to be credited for each month that the participant works. So again, it works out to be about the same, about 6 months. They would get credit for 1 year of service. The other method is elapsed time. This one is much more black and white. It's much more like, I don't need a lot of information. All I need is the participant's date of hire. So it's anniversary dates. It's literal years. Did you work 12 months? Did you work a full year? If you did, you get credit for 1 year of service. I don't have to reach out for hours worked or anything like that. I simply look at the dates of hire. It can get a little bit tricky if somebody has a lot of, they worked and then they quit and then they came back to work and then they quit. That gets a little bit messy sometimes. But if they haven't quit and gone back, it's very, very simple under this method. So I do have some examples because it can kind of be hard to see, but there's different vesting schedules that can be used, and your plan document will define them. This particular example uses a 3-year cliff, which is shown here. It's literally you're 0% vested until you have 3 years of service, and then you're all of a sudden 100% vested. There's different common ones. Another common one that NOVA sees a lot in our documents is a 6-year graded, where you're 0% until after 2 years, and then 20%, and then 40% after 3, 60% after 4, and so on. There's all kinds of ones. There's a 5-year grade. There's a 4-year grade. So the IRS does have parameters that you have to stay within. It can't take longer than 6 years for a participant to be fully vested, as an example. But I've seen some plan sponsors get kind of creative with what we have here. As long as you stay within the parameters, that would be okay, but definitely look at the plan document to see what schedule we're going based on. Okay, in this example, the plan is going to use a 3-year cliff schedule. We have a participant that has 2 years of service that they've worked, and then they stop working. Their account balance has $8,000 total dollars, but $5,000 is in deferrals and $3,000 is in match. Well, we know that deferral contributions are always 100% vested, but according to that 3-year cliff schedule, our person is 0% vested. So in this case, we are only going to distribute the deferrals, which is $5,000. That other remaining $3,000 that belong to the match is going to be transferred to the forfeiture account because the participant did not earn that money. That's basically all vesting is. So I have a different example here. We have a participant that has been credited with 4 years of service. This particular plan uses a 5-year graded scale. So 20% for year 1, 40% for year 2, and so on. So after 4 years on a 5-year scale, they're going to be 80% vested because it would take 5 years to get to the full 100. Their account balance, they have deferrals, they have profit sharing, and they have safe harbor match. So if you remember from before, deferrals and safe harbor contributions are always 100% vested. You do not have to earn those. On day one, you've already earned that money. But the profit sharing is subject to the vested the grading schedule there. He only has 4 years on a 5-year schedule, so he's 80% vested. So in this case, the participant is going to get $3,800, $2,000 in deferral, $1,000 in safe harbor, and then 80% or $800 of that profit sharing. The remaining money of the profit sharing, that $200 that's left over, is going to go back to the plan's forfeiture accounts. So the plan could then turn around and use that for other things, to make new contributions, pay fees, etc. Okay, so I wanted to quickly talk about, I know we're getting close to that hour, just how to avoid the most common problems. We want to process requests as fast as possible, but sometimes we have to put requests on hold because we have what we call NIGO requests, right? They're not in good order. For regular distributions, I can't tell you how frequently the participant forgets to sign those requests. We really need their signatures on them. We'll go ahead and review them. Same thing with the plan administrator signatures. We'll go ahead and review them, make sure they're good to go, but we will have to kick it back for signature before we can get it processed. Also, the #1 reason why I can't process a distribution is because it's a termination request and I don't have a termination date for the participant on file. NOVA will try to find that date. We'll look at our census data that we've received. We also check the record keeper websites. So if you have dates of term, as they come up, get them entered in the record keeper site. We will check that first before we bother any plan sponsors. So just a little piece of advice there. If we have those dates, we'll go look for them and we'll get them the request updated without having to put it on hold and wait. For loans, a lot of times the participant doesn't tell us how long they want to take the loan for. This is something that can't be an issue on an online request, which is one of the reasons why we love the online requests. But on those paper forms, there's a date there for like maturity date, and people don't know what to put, so they just leave it blank. Well, then we have to put it on hold to find out, do you want it for 1 year? Do you want it for 5 years? What do we want to do here? So definitely want to make sure that those requests, if they come to us, are fully completed. Also, if we don't know how often the participant is paid, and we don't know when their next payroll date is, I can't accurately produce an amortization schedule. So they're going to have to get put on hold until we get that data. I might know that you're paid bi-weekly, but if I don't know which week is the pay week, I still can't produce the schedule correctly. So those are the frequent reasons we have to put loans on hold. For hardships, it's just that documentation. Participants don't realize that they have to actually document that they are having a hardship. So they'll turn in the form fully completed and perfect, but if I don't have documentation, I can't process it. Currently, the IRS requires that plans have documentation of all hardships kept on file with the plan's records. It's not NOVA being mean or not believing people. We're just trying to follow IRS recommendations there. And if your plan's ever audited, we want to make sure we can provide the auditor with that information. So that there's no issues during your audits. So definitely want to make sure everybody's aware of that, because we don't want to slow down hardships at all, but we frequently do have to put them on hold. And then I wanted to talk very quickly about cybersecurity. Every single thing listed here on this slide is something that would have PII, or information that I could identify a specific person with. It's going to have things like socials, dates of birth, addresses. If it is identifiable information, then we have to be very, very careful about how we send these. We never want anybody to send these via email without encryption at all. And even more than that, we prefer a plan sponsor link. So there's an address there. It's our secure web portal. All NOVA employees have this also in our email signatures down there at the bottom, a link to it. So this is a way that you can transmit files to NOVA securely, and we can actually transmit files to plan sponsors securely. The plan's participants cannot access this, but any plan contacts would be able to. So if we can't use this, we would want to do encryption. You can email or call us and ask us to send you an encrypted email. If you reply back to an encrypted email, it will stay encrypted. Our networks are extremely secure. We have specific procedures to prevent fraud, like new plan contacts have to be authorized by an existing contact. We want to make sure that we have a good, secure email, that we have the correct phone number, things like that. In Nova employees, if we're internally sharing documents, we would never attach them in an email because that goes against all of our training. We have mandatory training, cybersecurity training every single quarter, every single year. We also have a very stringent password policy. All of our passwords are changed every 90 days. We use two-factor authentication whenever possible. I mean, we have two-factor authentication just to log into our computers and to log into our emails. So we take it very, very seriously, and we're always thinking about ways to keep our clients' data secure because it is so, so important to us. So this is pretty much it. Just a reminder here about the CPA credit. Keep an eye out for those emails. And then I just wanted to know if anybody had any questions.
All right, we do have one question that came in, which is, are loan payments double taxed?
So the loan payments are not double taxed. So the loan itself is not going to have taxes. And as far as like the loan payments being made through post-tax money, so in a way, I guess the amount that equals the loan repayments, that is going to be taxed again when the participant takes their distribution after they've terminated employment. That's only going to apply if it's a pre-tax source that the loan came from. So if a loan was taken from like a Roth account, then that wouldn't apply. Does that make sense?
Okay. And it looks like that's all the questions we have that came in. Alrighty. Do you want to give it a couple more minutes, or do you want to go ahead and close out?
Yeah, I just wanted to point out that we do have that first phone number is our participant line. And then we have our email address for our team. And everybody on the team does have access to that email address. So you're not waiting on one person if they're out on PTO or something. And that is monitored every single day. And then we do have mine and Stephanie's contact information there. So feel free to take that down and reach out to us if anybody has any additional questions later on.
Alrighty, perfect. Well, just a reminder to fill out the survey at the end of this webinar so that we may track who will be needing a certificate. If you have any questions, like Melissa said, you can go ahead and reach out to her or Stephanie, or you can email us at webinars@nova401k.com, and we can forward that over to Stephanie and Melissa. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you, Melissa and Stephanie, for your time today, and thanks again to everyone for joining. We hope you have a great rest of your day.